Hi, I'm Sokar. Welcome back to another day of looking at the small account in Robinhood. What an interesting day we had today. Oh my. So it's Tuesday, right after Labor Day. So we're just opening up in I'm in the wrong screen. I was double checking to make sure that my last video actually got posted because I didn't remember if it did or not. Anyway, so here we are. We're in stuff. So let's take a look at my primary investing thing here. There's my investing account. We're at 203 at the moment. Let's look at the week. Oh, just kidding. 203 is what I was at this morning. We made $26 ish, something like that today. And we'll take a look at what we did and why we did, and then we're also going to look at this and this. And we're going to look at an order that I had in place. I screenshotted it on the phone, but we're looking at this on the computer, so I may or may not end up putting that screenshot in this video, but the screenshot doesn't matter so much. It's just showing what I'm about to tell you. So let's take a look at what happened to the SPY today, which is of course the S&P 500. Oh my goodness, there it is. So right there is 6:25 a.m. and for some reason it just goes immediately to 9:49 p.m., which is right now, this very moment. Just wow, crash. It was a big sell-off day. The largest single company sell-off day in history. Nvidia was today. Nvidia did really well on their earnings report, which of course was last week, Wednesday or Thursday. I think it was Thursday. But their stock didn't really do much after announcements. I mean, they beat expectations. They're doing really well, but they're also probably overbought. I mean, I'm not going to go into detail about whether or not I think they're overbought, undersold, blah blah blah. At least not in this video, but for whatever reason, they didn't really take off after having a good solid announcement. And then, of course, stuff happened. But today, the company lost $280 billion in value. They're down 9% today. And Nvidia is either the second or the third largest company in the S&P 500. So it's massive. So when Nvidia feels a pinch, the entire S&P 500 feels a pinch. And of course, I don't have a heat map up. I could probably search for one, but it doesn't look good. It's red everywhere. It was a very down day. So early this morning, I got in and I decided that I was going to go ahead and sell a credit spread on the S&P 500 because it's in the upper ranges of the maximum that it's been at. It's looking fairly bearish. I'm pretty cool with it coming down in the near future. Did I say all that last week? Yes, I did. Did I sell a call spread on the SPY last week? Yes, I did. Did it lose me money last week? Yep. In fact, it actually lost me a decent amount of money. I lost, wait, where's it at? Where's my 1 week? Oh no, we want to go back to investing. That little, wait, no, 1 week. This little downturn right there, that was the exact call spread that I'm talking about from last week. It was right there. This one here was an oops. I was looking at different option strategies, and I didn't cancel them all out, and I ended up with one, and it, bink. I did get out of it, but whatever, it's cool. So yeah, this here was exactly that. So I'm in the same position again. In fact, it might even be at the same strike points. So let's take a look at my position here. I got in it this morning at oh no, I'm $1 farther out. So it's at the 564, 565, and what that means is I sold this call option right here. And if I'm selling a call option, that means I'm obligated to deliver the stock, 100 shares of this stock, at 564. Now, as long as the price stays below that, they're not going to exercise their option because they'd be losing money, so I'm good, I'm fine, whatever. And then as coverage, because if you sell this, you got to have lots and lots of money, or you have to have 100 shares, which means I need $56,000 in my account in order to just plain sell this naked call. So I bought this call for coverage. So worst case scenario, the SPY turns around, it skyrockets, it goes right up past its all-time highs into new territory of awesomeness, and it shoots up past this. Now, I sold this spread for 37 cents, which is per share, so $37 is what I made, or yeah, it's the credit that I got was $37. Now, if this goes above 565, anywhere above that, I'm going to be out $1 per share for 100 shares for $100. I'll be out $100. So my max loss on this is $63. 100 minus my 37 credit that I collected. My max profit is $37. What I collected for the spread. So I sold that right. It was before 7 a.m. Let's see here. My position. And this option is for Friday. Credit, yep, so I got in at 37 cents. It's currently trading at, I want to say 11. Oh, right here it's suggesting that it's trading at 12 cents. So, because I sold it for 37, if I were to buy it back in order to close my position out right now, I would have to pay out the $12. So 37 minus 12 means I would be making $25 on this spread right now, if I were able to close it out and if that's what I wanted to do. If this suddenly turns around and spikes up in the morning, then I'll actually, make less than that. But according to this here, I'm at $26 for the day. Oh yeah, because it last traded at $11. Got it. Okay, and I sold it for the 37. So there's a 26. So I sold the call option. Now, if I were really betting on today being such a down day, what I could have done is and let's actually put in a trade on this just to show what it's like. And again, everything I say is for informational purposes. I'm not putting out suggestions. I don't give advice, blah, blah, blah. This is educational purposes. But let's say I wanted to take a similar position again today. Let's say I wanted to sell a call spread. Let's see, where are we at? We're trading at 550 right now. Let's just go to 556. Just totally picking this at random, just making this up. So if I'm bearish, if I believe the price will continue to come down, I might be interested in selling this call option right here. And what that means is I anticipate the 556. Oh wait, this is tomorrow. Let's bump that out to Friday. Okay, there we go. Now we can go back into this again. These are the calls that I actually have right now. I sold this one. That's the -1. I bought that one for coverage. That's the +1. Way down here. Okay, so let's say I am bearish and that I believe this is probably going to be going down. Let's just decide that I want to pick the 556. I believe that between now and Friday, it's not going to come up, back up above 556. So I would sell this call right here. Now, because I don't have, it doesn't specify how much money I need, but you should have enough cash to cover 100 shares, which is $55,000 at that point. Because I don't have that, we're going to go ahead and buy the one right above it for coverage. So that's a typical vertical spread. It's a bearish call spread. I'm selling this one because I don't believe that it's going to be going above that, and then I'm buying the one right above it for coverage. So if I were to do this for Friday right now, I would bring in $97. So my potential loss on this trade is $100, which, wait a minute, which means my max loss is $3? I should totally do this. I thought it was an example. I kind of want to do it now. Okay, just an example. We're just looking at this. Okay, so if I were really bearish about this, though, I would say, oh, well, I've got a 97 credit here. Let's double down on my position. I am really convinced that this thing is just going to keep on tanking. I could switch over to the puts and buy a put. And I would have to come down a little below where it's at right now. So with this 97-cent credit here, I can spend some or all of that buying a put. So I could actually buy a put at 542 and basically get into this trade for free. I have a total credit of a penny. It's going to be worth $1 to me. It's basically taking the position for free is what it looks like. Now, if the SPY comes up, my break-even point would be right in here somewhere. Okay, so the break-even would be 554.36. So if it closed out anywhere 554.36 or lower on Friday, that's my break-even. And the lower it closes, the more money I'm making. You can see if it were to drop all the way down to 542, my profit there, I would be up $360 on the trade, which is right here. And then right there, because I'm buying this put spread, because I'm buying this put option, for every dollar it goes below this point, I'm making $100. Because I have the option but not the obligation, because I'm buying this one, to sell 100 shares at 542. So if it drops down to 540, I exercise my option to sell 100 shares. So I can just buy them off the market at 540, sell them immediately at 542. That will cash settle at $200 plus whatever the thing is worth. So decent amount of money. That is an option if I am really certain about the downtrend of this market. Now, if I'm kind of certain but not really sure, instead of spending all of my incoming credit here, I can drop another one out. Now I'm still collecting $14, and my break-even point here is at 554.87. So my break-even is a little higher. It seems like it was 554.34 before. Anything lower than that, I'm making money. And again, for every dollar it goes below this, I'm making $100. Dollar per share times 100 shares. So that is an option. And had I done something like that today, let's see here. I'd be looking at, with this particular setup, that's about as far out of the money. Oh, I said call options. There we go. Right here. So let's see, that's about $7 out of the money. I think that's even farther out than what I did, but approximately what I did. So if I were to have got a put option this morning, whoops, go back to puts, oh my goodness. In this particular case, it would have been about $8 out of the money-ish. So where were we trading this morning? Oh, just kidding. Go back. I would have had a put option right around 553. So right now that put option would be pretty. It would still be out of the money. Wait. 553, right? Because right in here it would have been about $8 out of the money. 553. 549. Oh no, that is solidly in the money. So had I done something like that this morning, as of right now, that put option that I would have picked up would have been worth about $400. That would have been a pretty good call. But of course, I wasn't gambling on it going that far south. I was pretty sure that it was going down, which is why I sold the spread to begin with. But just looking at this as potential options. So what actually happened was that spike there was not the spread that I got into. Let's see here, 705, 710, I want to say 720, somewhere in here is where I actually picked up the, it might have been right there, just a little after 7. I let the market open, I took a look at what was happening, and that's when I decided to sell the spread. So right in here somewhere at that point, somewhere here is where I sold the spread. And it went gradually up as the SPY went gradually down, or not so gradually, during the day, and then the market closed right in here. And for the day, I went from 203 to 229, basically entirely on this one spread here. So this spike here is this little 3-day option. And the reason I took a screenshot of this is I was like, well, I have seen this almost every day, right exactly at 7 a.m. It spikes in value. Look at this, $1.09. I got in this for 8 cents. That's $101 I'd be making on this thing. So what I did was I put out an order to sell at 40 cents. And I also put out an order to buy at 1 cent. So if its value dropped down to a penny, which it actually did, here it's showing the low point. Oh, there's 2 cents right there. So that's probably the low for the day. According to this chart, it didn't drop below 2 cents, which is why I didn't fill. So I was like, well, I like this position. I would not mind having another one. So I put in an order to buy at a penny, sell at 40 cents. Now it spiked up to $1.09, and it was after I put in the order, because I had the order out by right in here by 6:40, maybe by 6:45 here where it was at 20 cents. I'm pretty sure I had that beat though. Like it was right around 6. Oh wait, well no, it doesn't show. Investing account history. There we go. 3 option order, probably this one. Yeah, that one right there. So at 650 is where I put this one out. So it's identical to the position that I already have, and this one here, this is the one where I told it to sell at 40 cents. I'm not entirely sure how it managed to spike all the way up to $1.09 and not trigger the trade. I should have sold it. I should have closed that position at 40 cents, because there it is at $1.09. It traded at that. Now I have seen the value as it's moving throughout the day. I've seen the value drop to 0, which doesn't make any sense. It should be at least 1 penny, which is why I put in the order to buy at 1 penny, which is this one. What happened to it? History right there. Yeah, that's what we want. Yeah, this is it to buy at a penny. And according to the chart we were just looking at, the lowest point was 2 cents, so I can see why that didn't actually go through. I don't need that particular put. Oh, I clicked on the single put, that's why. But according to this, the low point was right there at 2 cents. So had I put it in at 2 cents, maybe it would have filled, but my 40 cent sell should have gone through and it didn't. Now, when I was trading futures contracts a couple of years ago, I had stop losses, and I realized relatively soon that having a stop loss was almost worthless. And that's because maybe it's just that it was futures contracts, maybe it's because of the broker I was using at the time. I'm using a different broker now. Actually, I'm using multiple different brokers. But whatever the case may be, if it went past my stop loss, it did not trigger. Meaning, if I had wheat at 5 cents or $5, what's the value of wheat right now? I don't even know. We'll use this SPY, but we'll use this trade that I actually had an order out. I had the order out at 40 cents to sell. Now, if it moves past that, it went from 5 cents to $1.09. It didn't actually hit 40 cents. It moved past it. Now, when I was trading my futures contracts, if it moved past it like that, it wouldn't trade. It would not trigger. It did not do any good, effectively, to have those stop orders in at all, because they didn't trade. The market, if it were moving against me, would just move right past there, skip over me, and then keep costing me money. So when I was trading futures contracts, I had to be on the contract so I could watch it and be able to drop it when my criteria said to get out. So it's possible that same thing happened here, because it's $1.09. And the reason I even put the thing out in the first place is because if we look at the past week, you can see the spikes. It spikes 7 a.m. right there. That one was at 45 cents. There's a spike. This one I think was 20. Oh, it's only 14 cents. That one was also at 12:30. It wasn't at 7 a.m. But bam, there's another spike. Let's look at the month, because I know there's another one. That goes back too far, actually. So I can't look at the month. It's basically a flat line all the way through there. 375. Yeah, it would just be a little bump. So I know there was one other spike though, because there was a 40-cent spike in addition to the 45-cent one. So it's possible that it moves past. I don't know. Tomorrow I'll be doing exactly the same thing. I'm gonna have, and I might move it to a different set of strike points. Like this is the 555 is my center point. I'm sorry, the 557 is my center point. So I might move it down a little farther. It just depends. but I'm going to try to sell it and buy it tomorrow just like I did today. And I'll probably do it at the same price points. I might do it at $2 to buy instead of $1 because it did hit 2 cents in here somewhere. There it is. So it did hit 2 cents at some point. So maybe I'll put it in at 2 cents instead of 1 cent. But I'm also going to go ahead and put the sell at $40. At, 40 cents per share, $40. And the reason that I'm going to do it is because I put in $8 on it. So collecting 40 in profit, I consider that worth it. It's not a bad decision. So there's the basic overview. This little spike here, that was the value of that spread, because at 645 I hadn't placed the order yet for the other one. I did that at 650. So actually right here is where I put in the call spread right here on the SPY. So this dropped, let's see here, 203, 180. That's 645. It looks like I picked up the call spread before that. I swear it said it went through it at 650 though. It might have been 640. It might have been. It might have moved against me for a couple of minutes and then came back into the money. Let's find out. That one. Oh no, I want my position. 37 cents. Date opened. Where's my time? I don't know. I swear it showed my time. Oh, the orders. History. Here we go. Yeah, that one. Oh, 634. Okay. Yeah, right immediately after the market opened. Okay. So yeah, the spike then, the spike down right here, 634. That's at 645. So yeah, it moved against me. This call spread moved against me initially, and then it's. Again, that's mostly the 3 option strategy. My butterfly right here, butterfly spiked to $100 freaking dollars, and then it went back to normal. So that's what it looks like. That's what happened during the day. So we're up for the day, $26 basically, 25. Let's see, 86, 78, 25, 92. It looks like we're basically up 26 for the day. Hopefully we'll be up a little bit tomorrow, just for fun. Let's take a look at the simulate my returns here. So gradual slope as the price stays below my target range. I could actually close out end of day. Well, no, that's after close. So anytime on a Friday, I'm sitting in max profit at the moment. If it continues to go down, that will continue to be true. And of course, the max profit here is at $37. And then at the moment, I'm at, well, that says 33. It must be using after hours price. It's still at 11 cents. I don't know why it's guessing at 4. Anyway, that's where we're at. Made a little bit of money. It was awesome. Moving forward tomorrow, I'm going to try setting up my sell and my buy on this particular butterfly right here. I might put in a different butterfly based on where it's at, and I might actually consider doing what I was illustrating earlier, where we sell the call spread and then buy a put out of the money to be close to break even or close to a free position. And I might actually do that a little farther out, because September is historically not a great month, and I'm looking at there being a pretty decent continued downtrend during the month of September. So, and of course we'll see. It could just dominate everything and become the coolest September ever on record, but it's probably not going to happen. I'm a little bearish at the moment, so we'll probably look at that. And then if I place any trades, or if I place some trades that don't go through, we'll come back and talk about it. But thanks for dropping by. I appreciate having you. We will at some point potentially be doing some explanations of different strategies, options strategies as well in the near future. We'll start going through things like showing what the credit spread was that I did this morning. But we'll do a video that's just on an iron condor. We'll do a video that's just on an iron butterfly. We'll do a video that's just on the green lizard, which I believe was coined by someone at Tastyworks, by Liz, I'm pretty sure. I could be mistaken, but I think that's where that originated. But we'll do separate videos for each one of those, and I'll go through and pick something, probably the SPY, because that's usually what I'm watching. Actually, where are we at on the QQQ? Trade options. Let's see here. It's trading at 458. If this drops to here, I suspect it's gonna drop significantly more than that. I don't know. We'll see. We'll see what happens. Not advice. Don't go out and buy a bunch of stuff. Okay, so if I were to sell, let's see here. Let's come back to the chart. Look at the week. $477 is a pretty solid resistance. 477.68 right there. Pretty solid resistance line. Where's that at here? That's right there. Yeah. That one goes all the way to 480, and that was a couple of weeks ago. So I would price some call options right at about 476, let's say. Let's take a look just to see what it looks like. I'm going to sell a call at 476. I'm going to sell that one. So it's far enough out of the money. Yeah, that's yep. I'm going to get $1. We're not going to do that. That's too far out. So if I were to try to play a bearish move on this, I'd have to come in a little closer. Let's just say we'll try at 465. Sell this one. We're going to buy this one for coverage. 27 cents. Robinhood doesn't show the probability of these being in the money, so I would actually have to sign into a different account. I'd have to pull up either Tastyworks or Thinkorswim, which again is probably going to be the two brokers that I'm actually using when we get our primary investment going in the futures markets. That's probably who we're going to end up using, but they show your probabilities of success, or rather your probabilities of any particular option expiring in the money, and that's kind of what you want to look at. And when I have those platforms up, we'll go over some of the strategies again, looking at those options, and we'll even do a video or 2 or 5 about math. Don't worry, I'll put it in a separate playlist because I know not everybody likes math, but math is everything, and I love math, and I'm particularly good when it comes to probabilities. So we'll talk about it. I'll put it in separate videos, or rather a separate playlist, so that those who are not interested so very much in math don't have to watch them. But thanks for dropping by for this video. Appreciate having you. I will see you in the next one.